So, Cathie, it's good to see you again.
Good to see you, Joe.
As I want to do whenever I see you, thank you for moving to Tampa Bay.
Oh, we're really happy to be here. It's been such a warm welcome, and the community so vibrant, and we feel very wanted, so very, very happy here.
Yeah, and you are. And it's a story people have probably heard a little bit, but it's one I never get tired of hearing. Why did you choose to come here?
Well, in 2019, as we were starting to scale in New York City, a couple of things happened. One, Art Laffer, many of you may know Art Laffer, Laffer curve, supply-side economics. The Laffer curve is all about taxes, and as taxes go up effectively across a certain threshold, cities lose businesses. Well, we were starting to scale into profitability, and he said, you have to get out of New York City. And so that was a kernel there, but more important was the notion that I have seen many asset managers in New York City and elsewhere, once they cross $10 billion in assets under management, they tend to struggle. Either they get fat, dumb, and happy, or something happens and maybe rest on laurels. And so I wanted to make sure we did something to shake things up and get everybody really excited, and to go to a community where we could help make a difference in many ways, both professionally and personally. And St. Pete, after we did look at a lot of both no tax and low tax states, we were drawn to Florida, specifically the Tampa Bay region, because of its vibrancy, because it did seem to us like it is going to be the next Austin. And I do mean the Tampa Bay region, because I don't think St. Pete could do it all by itself, something like a South by Southeast, shall we say. But I think both sides could do a magnificent job.
Wonderful. And I'm going to dig a little bit into how that's going to happen in a little bit, but a lot of that comes down to how we'll innovate. And innovation is at the very core of ARK's investment thesis. I'd like to try to help, as a lot of the folks in the room are innovative leaders in the tech space, break down how you see innovation playing with the economy and playing with new businesses, almost to a first principles level. How do you describe innovation and its effect on our world?
Yes. So an innovation platform in our world meets three characteristics. First, it's technologically enabled and follows a learning curve, which is expressed, of course, as through cost declines. And we use something called Wright's Law as the centerpiece of our research. Wright's Law is a relative of Moore's Law. Moore's Law is a function of time. Wright's Law is a function of units. And Wright's Law, believe it or not, is working better in the semiconductor industry today than Moore's Law itself, because of the slowdown in technology change there. So time isn't working as well as units. Wright's Law effectively says for every cumulative doubling in the number of units produced, each technology declines at a consistent rate. So for DNA sequencing, short read, that's 41% for every cumulative doubling in the number of whole human genome sequenced. For adaptive robotics, that would be 50%. For battery technology, 28%. When it comes to artificial intelligence, I mean, the breakthroughs are mind-blowing. They're happening faster than we expected, and we were pushing the envelope. So artificial intelligence training costs are dropping 60% per year when you combine both the hardware and the software. And so our latest take, and this isn't even in our Big Ideas 2022, it's just been coming hot off the research press, we believe we are within 6 to 13 years of the Holy Grail, artificial general intelligence, at which point we will see an inflection point in productivity that is going to be pretty mind-blowing. It's already mind-blowing what's going on. So, and then the final one is blockchain technology. That would be Moore's law, Wright's law, a little more difficult to, we're working with hash rate now to try and figure out the percentage decline.
Wonderful. And all of these cost-reducing effects are counter to inflation. And you've said that innovation is potentially the strongest hedge, one of the stronger hedges to inflation. Can you talk about that and your current feelings on the state of inflation?
Sure. And I'll just finish up on the innovation platforms. I forgot I was answering that question, just got right into artificial general intelligence. So cost curve declines. The second characteristics is that these technologies are going to cut across economic sectors. And so we have set up our research department, basically turning traditional research on its head. Our analysts, each one of them is specialized in a technology. So the 5 innovation platforms involve 14 different technologies. We have about 12 analysts right now, and most of them specialize on 1, maybe 2 technologies. So technology specialists, sector generalists. And then the third characteristic is these platforms serve as launching pads for more innovation. So if we had not made breakthroughs in DNA sequencing, we wouldn't have CRISPR gene editing today. It wouldn't be possible to find mutations. So those are the 3. Now, in terms of inflation, deflation, this has been, the last year has been, it's been the most difficult in my career. It has been much worse than 08-09. And the reason is the narrative about inflation and interest rates kicking up and really increasing the discount factors that we use to present value future cash flows. So when interest rates go up, the present value of future cash flows goes down. And so our strategy was hit disproportionately. Now, we have been fighting this notion that inflation is going, it has now reached a point where it's embedded in the system, is going to move into wages. I know the wage rates here, we were talking backstage, have skyrocketed. I think this is a special situation. So we're fighting this narrative that we're back to the 70s, which is embedded in the system, get used to it, operate around it. From our point of view, the deflationary forces out there are very significant. Certainly, all of the platforms we're talking about, they've started out from low bases, but they are getting to be big enough now that they are going to start moving the needle in terms of inflation. So from a secular point of view, our conviction is very high that the bigger risk is deflation. When it comes to innovation, deflation is good. So it's not a risk. The risk is you stop innovating and lowering costs. But so that's good because lower costs and prices cause a boom in demand. And we think for the 5 major platforms, we see many areas where there's going to be booming demand. The corollary to this, however, is the other side of disruptive innovation is creative destruction. And we think the traditional world order is up for a wake-up call here, which is quite significant in my business because our business has evolved into a very benchmark-centric business. Just get close to your benchmarks, don't take too much risk. And to be honest, most of our stocks are not in benchmarks. So that's one reason we've been hit so hard. Fears of inflation going up and interest rates. Analysts and portfolio managers move back to their benchmarks. They're selling our stocks. And this has been a brutal slide, peak to trough, 75%. Now, one of the reasons this has happened is inflation, but another one is we've been kind of lumped into the stay-at-home category like Peloton. We are not Peloton at all. These are innovations that are going to transform every sector, transform our lives dramatically. The creative destruction is going to be a problem for companies that have really listened to short-term oriented or catered to short-term oriented shareholders who wanted their profits now, they want their dividends now, and so what do these companies do? They leverage up to buy back their shares so that they can engineer higher earnings. From our point of view, true growth, real growth, starts on the top line. You can't fool us with that. So I think we're coming to the end of this, though, of this period of uncertainty, because just in the last week, we've gotten some earnings reports which are saying the creative destruction is underway, and it is going to be shocking. So in this past week, Walmart said its stores had gone up, store sales had gone up 3%. Well, that's a decline in real terms, so units are down. Inventory is up 33%. Target even worse, 3% sales, which means they were down in real terms. Inventory is up 42%. I think what's happening now, and it's going to happen to a lot of companies and industries with high fixed cost bases. I think what's happening is online retail is now moving into overdrive. It's now 14% of total retail sales in the United States. Whenever we see a trend move into that 10 to 20% share range, it's usually moving into overdrive. Who is that going to disadvantage? Bricks and mortar. Their cost base is just much higher than online. We also saw Cisco announce a very disappointing report last night. So this is Cisco Systems, not the food company. And one of the stocks for which we've been criticized is Zoom as a stay-at-home stock. That stock has gone from, I think it was 600 at its peak to 80. And this is just within the last couple of years. What many people, and maybe this will appeal to the audience here, what many investors don't appreciate is that we are in the first rip and replace cycle when it comes to the enterprise communications part of the tech stack, which is the biggest part of the tech stack, $1.5 trillion in revenues globally. First rip and replace cycle since the early 90s, when Cisco started laying the foundation for the internet, or the backbone of the internet here. We're moving away from on-prem, hardware-centric solutions to the cloud, and Zoom and Microsoft are the two winners there.
And you mentioned the narrative around inflation and interest rates, which is, narrative by definition is human. Markets are human-driven. So what is the human narrative coefficient in your research? How do you factor that in?
How do our analysts?
Yeah, as far as the effect of this, mass narratives that can happen, that can affect markets, how does that affect your buying decisions?
Oh, I see. So what we've done in the last year, in what many people thought would be apocalyptic for us, and fully expected us to be outflowing and just, basically disintegrating, we've had inflows. Not all last year. We had big inflows toward the beginning of last year, so we netted $17 billion last year, and we are inflowing this year as well. We have a very young analyst team. They have not been in other firms. Had they seen what would go on at another firm in this kind of period, they probably wouldn't have joined our business, but that's not how we operate. We keep our eye on that 5-year time horizon, and so what we've done during the past year is concentrated our portfolios towards our highest conviction names. And so our flagship strategy, ARKK, has gone from 58 names to 35 names, and it is a risk control measure in a way. Many people would say, wait a minute, concentration is not risk control. In our world, it is, because there were 23 companies where our scoring system wasn't quite as high as it was for the other ones. And some of the reasons that might have been, and this was the case in a number of situations, if there's a changeover in management teams, and we're not just talking about a change because the company is moving from early stage into scaling, not that kind of change, but a change at the top, visionary managers willing to stand up to short-term oriented shareholders, then we get a little bit concerned. We don't know if that's going to end up being the winner in the particular space which we're focused. So there are all kinds of reasons. So we've concentrated the portfolio towards our highest conviction names. And we will see, it's so interesting to watch our portfolio. It's almost become negatively correlated to the stock market. When the stock market's going down, and certainly when the value part or the cyclical part of the stock market is going down, we're usually soaring. When the rotation is back to value and cyclical, we're usually on the losing end of that. So that's been the story of the past few years.
And that speaks to you being at the front edge of innovation. And you talk about the 5-year time horizon. It sort of mimics a venture capital mindset.
Yes, we in order to help people understand, investors and others understand who we are, we started the company by saying we're the closest you'll find to a venture capital company in the public equity markets. And I think people really do understand that. That's why we have retained assets, and maybe people have been averaging down, because they know we have a 5-year investment time horizon. We are out there all the time. On social media, we're giving our research away. We're feeding our clients with transparency that they're not going to see anywhere else. And I think that has engendered a certain loyalty to ARK. I'm out there in the media. Some people say too much, but that's because they're replaying clips of what I'm saying. So I don't go out there that much. They'll just, I'm good clickbait or something. So they use these reels over and over again. And our analysts are out there, and we are now publishing our models increasingly on GitHub. Our Zoom model is going to go out in 2 weeks. It'll go out on GitHub. Tesla's out there. We have parts of Square. That full one will end up there. So we're going to keep publishing our models because we realize that the traditional financial world is not serving investors well in the innovation space. And we want investors to actually be able to play around with our models, or advisors, play around with our models. If you don't agree with one of our assumptions, change it in there and see how the price target changes.
So as executives trying to get their head around, have an innovation mindset and solve look to start solving tomorrow's problems in innovative ways. Sometimes you can say there's, the MySpace that became the Facebook. How do you know if innovation is sort of a place and time for a company? What's sort of that life cycle, and how should we observe that?
Well, we are very concerned when a traditional company buys an innovator. So News Corp bought MySpace and killed it with advertising, because that's what they do, right? So Facebook was much more... they saw what was happening to MySpace, and they were taking advantage of the situation, making it a little exclusive and, somewhat free of advertising in the early days. And then, of course, the model changed, as we saw, as the network effect took off. I believe one of ARK's biggest risks right now, given how low our valuations are, the valuations on our companies, is that they are going to be taken out. And if they are, they'll be smothered. That's what usually happens, especially if it's a conglomerate. So we're very focused on pure plays. Now, if you are in a big company and you do buy one of our companies, then let it alone. Just let it fly. Don't try and impose a certain structure that is probably going to harm the business. So that's one thing that I would say. And in terms of, our scoring system will tell you a lot about what we think is important in terms of companies and innovation. The first one is a visionary leader willing to stand up to short-term oriented shareholders, as I said, but also someone, Elon Musk, Tesla has been our largest position for a very long time. I think today it just slipped below because it was down and our other stocks were up. But, Elon has been a fierce visionary focused on battery technology and autonomous technology with the goal of saving humanity from itself in terms of the environment and climate change and so forth. So passionate, driven, relentless, sleeping on the floor of the factory when they were having trouble scaling the Model 3. So management, people, and culture is critical. I love speaking with executive teams and not just them, but the way we've set our research up. When we give our research away, those who are attracted to it and respond to us are usually in the trenches at these companies innovating, and so we're getting feedback from them. But the apple, or what is it called? The apple doesn't fall far from the tree. The vision is set from the top, but you can see it if it's filtered all the way down. The barriers to entry. Are you meeting are you filling an unmet need? And how much competition is there out there, especially technologically, and we can see that with product and service leadership through market share. That's very quantitative. Execution to us, while executive may be talking to the street, and they'll talk about execution in terms of hitting profit margins to the decimal point. We don't care in the early days. We want our companies to spend aggressively now to capitalize on these massive growth opportunities. And just to size this for you, right now in the public equity markets, truly disruptive innovation, which is all we do, we believe is valued globally at roughly $7-8 trillion, less than 10% of the global equity markets right now. By 2030, we believe that 7 to 8 trillion will be 210 trillion, and that it will dominate the benchmarks out there. In other words, there's going to be a lot of disruption. But that opportunity, many people say, that's crazy. Tesla, we were beating the drum on that. Nobody believed us, and boom, they scaled. And they are leading in the electric vehicle space because they were so early and are scaling. So I think it's very important in terms of execution that the R&D dollars are sufficient and they're spent in the right areas. So we spend a lot of time talking to management about that. And especially now that artificial intelligence is going to become such an important competitive weapon. And just to give you a sense of that $210 trillion number, 2 years ago, it was 3 years ago, it was 75 billion. It's gone from 75 to 210, mostly because of the breakthroughs in artificial intelligence that we're seeing. So I think R&D, where's the focus? Are you spending enough on it? And are you spending enough in your other areas, sales, marketing, as your product's rolling out, to scale and gain the lion's share of what, in many cases, thanks to AI, are going to be winner-take-most opportunities?
And again, that's very much the venture capital mindset, right?
Yes.
Spend now and win the big prize later.
Yes.
Because I want to, it's topics I have to get to on with time,
Okay.
the few minutes we have remaining. Crypto, understanding the movement from retail to institutional took a big hit with the Luna and Terra issue. So Luna is the first attempt, or Terra is the first attempt at a major attempt at an algorithmic stable coin. So instead of just the traditional reserves sitting back, they're trying to have this volatile asset that helps stabilize the stable coin. And they had a blip. So I'd love to hear your take on that.
Sure. I think what's been fun for me in the crypto space is here these young people they're natively crypto. I mean, they come to us, our genomics analyst. I had no idea how familiar with crypto he was, how much he invested in it. So young people this is the rabbit hole that many of them are falling down. What I bring to the party is economics And as soon as, so Do Kwon, who is the founder of Terra, we had a podcast with him about, I'm going to say 18 months ago, maybe it was a year. And I listened to the podcast, and then I listened to parts of it again. And I basically said, this is a Ponzi scheme. It is. It was.
Wow.
It was. I just learned today that Luna, which was supposed to be the stabilizer for Terra, Luna, the number of Lunas out there, I don't know if that's how you say it, units of Luna, have gone from, I think it's 300 million 6 weeks ago to 6.5 trillion.
Well, they adopted the U.S. policy on on printing. Yeah.
Well, you make a point. And yet, one of the arguments we're having out there, and even Elon Musk and I are back and forth on this one, I believe the velocity of money is going to fall again. It's been falling since 1997. It collapsed during the COVID crisis as people were very afraid. It has flattened out for 2 years. And in order to have a 70s style inflation, you need the velocity of money to turn up again. I believe with consumer sentiment back down near 08-09 levels, despite booming employment, that the consumer is scared to death, seeing his purchasing power eroded the way it is. And I believe that we saw from Walmart and Target today, this week, a manifestation of that.
So, crypto has a certain presence now. So I'm speaking to the velocity of money. So as, a lot of cryptos are crypto assets, right? They're not currencies and they don't fall into the same category as money. So when do we see a place where the outflow of resources into crypto, have any kind of real effect on that velocity or change the way those stats are calculated?
Right. You're talking about, and especially Bitcoin, mathematically metered to top out at 21 million units, so good store of value, right? When will this impact the dollar?
Well, I mean, even as it goes up, it can absorb infinite resources into it. The price just keeps going up, and so at some point that brings more resources outside of our traditional ecosystem or
rails. I think the first place we're seeing an impact, and we are seeing it, is in the emerging market currencies. They are tumbling. And emerging markets understand what loss of, or people in emerging markets understand what confiscation of wealth is in a number of ways. Inflation, the most pervasive. And so we are seeing adoption, just as insurance policies, in the rest of the world. And I do believe that especially Bitcoin, to some extent Ether, is starting to have an impact on the velocity of those money supplies. Now, the US dollar is a flight to safety currency. It's up 15% in the last year. And so I think you'll have crypto. And now with Terra blowing up, I'm sure many people are a little unnerved because it's hurt other crypto assets as well. Bitcoin has even weakened because of it, even though it shouldn't. So I think there's a little bit of nervousness around this. So this is why the dollar's gotten a little bit of an extra kick in here. So I don't think it's going to be hurting our velocity of money. Increasing our velocity of money anytime soon. I think this is more of an emerging markets phenomenon. Could be a euro phenomenon too, because the euro has not only north-south divide. So Portugal, Italy, Greece, Spain, but it has now, with Hungary, an east-west divide. Hungary is now a showstopper. And so we do wonder about the euro, its sustainability long-term, because now they've got even more pressures on them.
Just that we're even having the conversation, picking places in the world for such a young technology is, I think, noteworthy.
Yes.
Yeah. And taking that a little bit further, if we look at the basic, purpose of money and security of it and agreeing that it has value, is there a point where Bitcoin, because of what it has as far as borderlessness, free of influence from monetary policy, free of seizure, that the next generation comes in, as you mentioned, with this mindset of this being normal, Is that what starts the explosion to get to the place that you predict it will
That
go?
we think,
Yeah.
yes. So we're out there saying, and you can find this in Big Ideas 2022 on our website, with a $1 million target. It's actually 1.3, but so 1 million, and you'll see the building blocks of how we get there. The reasons Bitcoin will get there, substitution for gold, the emerging market currency, the remittance, a way to evolve the remittance industry. So we're looking, so the one description that you left out was rules-based. This is so critical, that mathematical metering, and Bitcoin is the most secure blockchain out there. So this is a money revolution, and we do think it is going to spread throughout the world. Even here in the United States, I have a lot of Bitcoin. We will all have insurance policies. We talk about the other cryptos in two other ways. So you've got the money revolution, which is what we've just discussed. Then you've got the financial services revolution, which is DeFi, decentralized financial services. And they've all been hit hard. And whenever you get a Terra, there's, a seizing up. But we do believe this movement is unstoppable, taking all the middlemen out of the financial services, meaning the toll keepers, and providing financial services for those that banks can't afford to take on right now, as well as everyone else. So that, and really taking the middlemen part of the spread out of the bid and ask, borrowing rate and lending rate. So that's a big part of that one. And then the third revolution is the next generation internet revolution. This also has to do with property rights, of course, NFTs, and I know, Joe, you know this. We're talking about the first global, private, again, no government oversight, immutable, and they're working on that. We're trying to make sure that's the case, immutable digital property rights system. So we know that from economic history, so Hernando de Soto and Thomas Sowell, the best way to lift people and countries out of poverty is to give them secure property rights. So we think this is a very big deal. And sure, we're in very early stages. This is where the internet was in the early 90s. Nobody thought it would work long run. We listened to the squeaking on our phone and said, how's this ever going to work? And look where we've come.
And that property includes real estate, but also any type of good or service.
Any type.
Mm-hmm. And one thing that didn't make that list was transactions and payments. How are you feeling about the Lightning?
So digital wallets?
Well, the Lightning Network was going to be my next question.
Oh, the second layer solutions?
Second layer, yeah. So how are you feeling about Lightning?
Yes. Okay, so in terms of Bitcoin, really love what's going on there. We're watching the channel count, the node count, and it seems like there are some very interesting applications evolving. So we just look at usage and we look at developers. Where are the developers going? I always say follow the developers. And I love the fact that with the Lightning Network, again, this is more Bitcoin centric, we're going to move purely from the store of value role for Bitcoin, but maybe towards a means of exchange. Now, this is economics, and we can bail out of it if you'd like, but if Bitcoin is as successful as we think it will be, when I first introduced Art Laffer to this idea and asked him to collaborate on our first white paper in 2015, he said, "This is what I've been waiting for. Back to a rules-based global monetary system, since we went off the gold exchange standard in 1971. And he said, I don't think it's the right rule because it's a quantity rule. That's good for store of value. Means of exchange, the rule is a price-based rule. So we shall see how they evolve the ecosystem. He said, they'll figure it out. I don't know about that. These core developers are not going to move from that 21 million units.
Yeah. Well, then maybe alternatives like the second layer solution. I'd be remiss if I didn't give a shout out to Gabe and Rosa from Block Spaces who are killing it at their new Lightning products and really leading the way from a thought leadership standpoint. So let's, in our last few minutes, let's bring this back home to Tampa Bay. If we think of Tampa Bay as a region, as a startup, or as one of the companies you'd like to see innovate, or you'd be looking at, what are some of the ways you think we can plug in and innovate as a region?
Well, I'll tell you, first of all, the 5 innovation platforms, open up to them and welcome them. It's been very interesting. Through the Innovation Center, we're working with St. Pete on that. We're using our research to be the screen for ideas, hopefully more and more as time goes on. Because we think, first principles-based research is critically important to selecting the winners in an evolving ecosystem. So incubators, and I know Lakshmi, Tanya at Innovation Center, Lakshmi at Embark Collect, amazing that you have such a focus on innovation. And so we would love to be the screen. And any one of those areas, talking to Johns Hopkins here, very interested in that. Bitcoin, incorporating Bitcoin into the utility infrastructure here so that mining Bitcoin will provide the funds, whenever with this intermittent energy source, you fill up the storage and then let the overage go into Bitcoin mining, you can proliferate solar and wind much faster than otherwise would be the case. We did a whole day practically on this in the B word with Jack Dorsey and Elon Musk. So I think that, and I also think education. So again, we're trying to, as I mentioned before, we've come into this community hoping to make a difference. We are piloting this fall 6th grade science. We will be the 6th grade science curriculum in 6 middle schools. And that is apparently, we shall see, walk before we run, but they have plans to take us throughout the middle school. Our research, education through the lens of our research, adapted for that age group, I think is a great place to start, and get them into our incubation centers so that, this can become a virtuous circle in this community. And
that's a bit of you have an innovation foundation, so that's when you talk about curriculum, and that's sort of a departure from the economics we're talking about. But yeah, really fantastic, visionary, STEM-based innovation foundation, and you've been partnering with the school system and have your program, and you are the science curriculum for a number of classrooms, so really, really fantastic. Always illuminating and
thank you.
Fun to speak with you.
Well, you're a great interviewer, so.
Thank you. Thank you all for coming, and I think you have one more event.
Thank you.